I don't have words to explain. It's been such a long day for you, and we kept you waiting also. Thank you so much for making time and making the effort to be here today. So let me dive into this straight away. The talk of town for the last 1 year has been these F&O regulations, which finally took effect on November 20th. We've just seen the effect of the first round of changes that got made on November 20th. Another 2 rounds to go. January 1st is one big thing. Looking at how things have panned out after November 20th, actually December 1st, what is your sense? Have you accomplished what you wish to accomplish?
Thanks a lot, Mahalakshmi and Moneycontrol, for having me. It's been a long day for you guys as well. And the regulator's job is to be boring and to put you to sleep, which is what I'll try and do. Look, as far as futures and options and derivatives is concerned, this is a journey. It's a continuum. It's not, discrete points in time that we're trying to do different things. It's a modulate as you go kind of a situation. Just to be clear, the objective, the regulatory objective that we had was not really against futures and options in toto, not at all. It was basically to address what we saw as egregious overtrading on expiry day in index options. So very, very specifically this particular segment. And the reason was twofold. One was we did see an element of investor protection kick in. We've been publishing these, research from Sebi from time to time, from January 2023 onwards. We, refurbished it again recently, which showed that well over 90%, 93% in the last 3 years of investors have actually been losing money in F&O. And despite these statutory warnings, including on broker screens, the volumes were continuing to grow. And secondly, there was an element of potential stability risk as well. So when you see overtrading and zealous overtrading happening on expiry day, with open interest actually increasing right up to a few minutes before expiry, then the size of the positions becomes so large that, God forbid, if you had a 9/11 kind of a global event, the stress results were becoming a little wonky. So this was a twofold objective of just focusing on expiry day index option volumes. The steps that we've taken are largely towards that. As you said, a part of it has kicked in so far. It's too early to tell what the impact is because, this is not a univariate equation of regulatory action taken and volumes resulting from that. You have to take into account seasonality, you have to take into account mood of the markets, you have to take into account what's happening, in the markets itself. And it's also December, November was a festival month. So it's very difficult to tell, but at least the first couple of weeks with all these caveats that this is not indicative of what's really happening or set to happen on a long-term basis. We've seen the notional volumes come down. Right. It's come down by 35 to 40%. Right. We've seen the premiums, in terms of premiums, the volumes come down by much less. It's hardly been some 8-9% down. And again, it's not very clear if that's the right trend. The option per contract or the value per contract has gone up quite substantially. Going purely by this and with the caveats that we don't know if this is the right trend to look at given there are so many other variables involved, this seems to be in the direction that we wanted. After all, what did we want? We wanted the number of trades on expiry day to come down because there were really small option premium trades being churned every 3 minutes. So notionals coming down is a good sign from that perspective. Option premium itself not coming down by that much is a good sign. We want a healthy F&O market. And option size per contract going up by 50-60% is also a great sign. And remember, things like the increase in the notional size, things like less number of expiries during the month end, all that haven't kicked in as yet. That will kick in subsequently. So I think it's going in the right direction, but we are in no hurry to recalibrate what we've done. We will take a deep, long look at how things are panning out. One of the boards in my room says, first, do no harm. We are not in a rush to regulate to try and control the market. We know that's not the way in which the world operates. We'll take a nice long look at it. We'll discuss with the market participants and see if further calibration is required.
Right. So one of the things you've also, talked about in the past with respect to these recalibrations is that your worry about this expiry day volatility. And that hasn't changed. At least for the 2 weekly expiries we still have. Even last Friday was a demonstration of that. You had like a 2,000-point move. Is there any way but to do away with weekly options altogether to rein in this volatility?
So let's break it up into two parts, Mahalakshmi. Our intent was really to try and address overtrading happening on expiry day in index options. We did not talk about volatility.
Okay.
We talked about the fact that there is too much of egregious, zealous overtrading happening, particularly by small retail investors in index options on expiry day. It was practically a game of 0 day to expiry kind of trading happening on expiry day. Now, that was our objective from both an investor protection perspective as well as a financial stability perspective. We did not talk about volatility per se.
Okay, so
now,
volatility
having said that,
itself...
on volatility, let's take the second part on volatility. Ashish was here just now. Exchanges as well as Sebi has adequate measures of surveillance, and we are constantly updating them. Trust us, we look at things. Even when the markets are, even when there is no talk about what's happening in the market, there are enough checks and balances that we have. We have enough alerts that are coming up at all points of time, which are taken to their logical conclusion. So trust the exchange and Sebi ecosystem. Surveillance systems are in place. If and when we see something which is wrong, we will absolutely act. And we have not hesitated to act earlier.
Sure. One question on the latest consultation paper on algo trading norms. What do you wish to accomplish out of this? And you've said that, for black box trading algos, they will also have to, they don't have to divulge their strategies, but they have to keep records of all their data and trades and stuff like that. Do you think our regulatory system and the exchanges are ready to sort of take on this kind of data and prevent flash crashes and stuff like that, which is what I would think is the primary worry?
So first of all, this is being directly handled by my fellow whole-time member, Kamlesh Vashne. So I'm giving my personal views here. It's not something which I'm looking at directly. With that caveat, let me tell you what my personal views are. And I'm only one voting member of the board.
Right.
I'm not the board as a whole. One is, I think the rationale behind having this algo trading being brought out in this fashion is to try and formalize something which we know is happening. If there is something happening in the background in an informal, unregulated manner, let's give it a chance to come to the open and become part of the ecosystem where everybody is taking a look at it. It's to formalize what is currently informal and give a chance for formalization. Now, personally, I would strongly urge investors not to be too enamored by these algos, particularly the small investors. Think of it this way. If there was a really smart algo which was designed to beat the system and to be constantly positive, what are the chances it would be offered to a retail customer for a fee? Yeah. It would first be used by the algo provider themselves to generate nice supernormal profits. If you don't have sufficient capital as a algo provider, you would probably hitch up to a large institution or to a large client with deep pockets to then draw that capital to run this particular algo. Only in the off chance that you are a really bright guy who's come out with these fantastic ideas and nobody is listening to you, only then will you come to a small investor. So the chances that you are getting something which is a bonanza, frankly, is fraught with risk. The second point is, something that we have discussed before, Mahalakshmi. I think it's important that investors understand, and FNO is a point in that direction. Trading a lot as a retail investor, research has consistently shown, is a great way to reduce your returns. The reality is the transaction costs, the taxes, compliance costs, the fact that we charge you something for every time you trade, the fact that exchanges, the brokers, there are so many other frictional costs involved, means the house is loaded against you every time you trade. So as a retail customer, I'm not talking about institutions, I'm not talking about HNIs with deep pockets. As a retail customer, the more you trade, the less you make is what research consistently shows. Now, if you're fully aware of this and you still want to deploy your hard-earned money into various enterprises, that's your prerogative. By all means, do what you're doing. We are not a nanny state, as my chairperson has often said. You are free to do what you have to do with your money, but just be aware of the risks. When we said 93% of retail loses money, there is a reason behind it. We saw this for intraday trading as well. 70% of intraday traders, particularly the small guys, lose money. So reality is, as a small investor, your best bet is to do the right asset allocation, to stick with that asset allocation, only trade to either add to your investments or to rebalance your asset allocation. That's your best bet for making long-term meaningful returns. Now, of course, there will be people who trade and make money, but that's like a normal graph which is skewed against you, where the bulk of the people will actually be losing money. There'll be a few outliers who actually end up making money. So my earnest request would be, while we have made this algo provision more as a reason to formalize the whole process, please do not take this on face value. Remember that, often algos are curve-fitting exercises. They can be back-tested to show fantastic results, but past is it cannot be extrapolated to show what happens in the future. Do not look for this, magic snake oil which will make you a billionaire overnight. That doesn't exist in reality. Be aware of these risks and then take your call on what you want to do.
Okay. We don't have much time. Just one last question again. There is a feeling in the industry that regulators, all regulators, whether it is Sebi or RBI, there is a lot of changes that are happening, and it makes life difficult for them because they have to constantly adapt to whatever comes your way. What is your thought, and what is your comment on that? And secondly, what is your advice to the fintech founders here in terms of how do they cope with all these changes that come their way?
So partly in jest, and thank you for saying this is the last question. Partly in jest, we had this bunch of foreign portfolio investors who came to visit us, and one of the comments that I heard my fellow board member make was, the reason foreign investors like India, and this is in the medium and long run, is because we are like this 15, 16-year-old showing a lot of growth pangs, right? We are actually growing quite rapidly. We have fire in the belly. We want to actually prove ourselves. There's a lot of angst. There's a lot of aspirations. So we are like this teen with a lot of growth pangs, right? Now, you can't expect an economy to be like a teenager with growth pangs and to have the regulatory sagacity of a 60-year-old, right? So you will find that it goes together. Now, jokes apart, this is something that we think about a lot. And I've said this before, and you're going to fall asleep hearing me say this again, Mahalakshmi. We worry desperately about two kinds of errors that we could make as a regulator. The first error is when we let something bad happen. So when a Harshad Mehta happens, or a Ketan Parekh happens, or any other scam happens in the US, and Enron happens, FTX happens, or whatever, that's a type 1 error. And the inevitable questions from many in this audience, and Mahalakshmi herself, will be, what on earth were you guys doing? You were sleeping at the wheel, and didn't you know the whole world knew this is going to happen, and you guys are clueless. So that type 1 error is what keeps us awake at night. That tomorrow if you have a cyber attack, tomorrow if God forbid something goes wrong in the exchanges, tomorrow if there's a scam which is unearthed, that's a type 1 error we will never, live beyond. But we are equally conscious of the possibility of type 2 errors. And that is when, in our zeal to reduce type 1 errors, we make regulatory frameworks so onerous that it comes in the way of good people doing their business. That's a type 2 error. And I assure you, we give equal importance to both. Because after all, our job as a regulator, if you look at the Sebi Act, if you read the entire Sebi Act, don't even read the entire Act, just read the preamble. It talks about investor protection, it talks about market development, it talks about market regulation. Those are the three pillars of our mandate. which essentially means capital formation. So while you think of us as this nasty regulator who's issuing circulars by the dozen, our job is to actually ensure that capital formation, that cycle, continues in a nice, robust, sustained manner, which means savings come into the capital markets that is used by issuers to raise money, to set up businesses, create jobs, therefore create more savings and make it a nice, virtuous cycle. That is our job. So when we create type 2 errors, or when we create the room for type 2 errors, we are not delivering on our capital formation mandate. So what do we try and do to avoid this type 1 and type 2 errors? And by the way, we have to minimize both. If you're a statistics student, you will say that's impossible. You can't minimize both together. This is where the analogy stops. We can actually try and minimize both. This is not statistics. So what do we try and do? We start off by realizing and recognizing that we don't know as much as the industry does. Sitting in our ivory towers in Sebi, there's only so much we know. We have to constantly speak to you guys and girls to figure out what the hell is happening on the ground. Okay? So the need for consultation is something that is ingrained in our DNA. So every time we face a problem, a regulatory objective, either to ease of doing business or to actually come down on regulatory, to curb some regulatory malpractice, we do a lot of consultation at multiple levels. First, we have advisory committees. We have multiple advisory committees from our primary markets, secondary markets, for mutual funds, for AIS, for FPIs. So we go to the advisory committee. This advisory committee has some great people, experienced people from the industry as part of that. We then launch a public consultation. My strong advice to you, if you're part of this industry which is suffering because of regulations, talk to us. We look at your feedback to the public consultation. Today we had a board meeting. Every single board item had, here is a public consultation, this many voices for, this many voices against, what were the major issues against, what is our view on it, what is the relaxation therefore we are doing, or why are we not going ahead and listening to what the feedback is. And by the way, because we are subject to all sorts of reviews as a government entity or a semi-government entity, we have to look at every single feedback that comes. For the FNO, we had more than 10,000 pieces of feedback which came. And we went through every single one of them. So talk to us, tell us what's going on, and even better, if you can put together an industry, a CII, ASSOCHAM, or in the case of fintech, if you have a association of sorts, which can give a unified voice, that really helps us. We need trusted advisors who can come to us and say, you know what, this is the right thing to do, stop doing this, stop doing that. So talk to us in the consultation. And it doesn't stop there. When we come out with a regulation after all this consultation, when we translate that to do's and don'ts on the ground, even there we consult with the industry. So a regulatory intent converted to do's and don'ts goes through something called a standards forum, which includes industry. In fact, it's led by industry in consultation with us, saying this is your regulatory intent, therefore these are the do's and don'ts at the ground level. Again, please consult with us on that. Be part of that consultation process. We would love to hear from you on that. So last piece of advice to you I have is, and I've been on the other side on industry for a bulk of my time. I've only been a regulator for 2 years. Having seen both sides, I can tell you one thing which works. You have to be a trusted advisor to the regulator. That's important for you, that's important for us. If we see you only talking about type 2 errors, ki ye regulation ganda hai, when you're turning a blind eye to what we can all see are egregious type 1 errors where malpractice is happening, then we can't trust you. What we would much rather is, if you see something going wrong, please come and tell us about it. We would much rather hear about it from you than from our inspections or from our friends in the media or from other intelligence. You tell us, listen, this is what we think is, this is not snitching. This is taking care of your own ecosystem and preserving that goose which is laying golden eggs. So become trusted advisors, advise us, you will find we are more than happy to listen to unified voices coming to us and teaching us what needs to be done. So look, regulations are far too important to be left to the regulator. You have to be a part of the process. We have tried to make sure this is a consultative process. Talk to us. Trust us when we say we listen to you, talk to us.
Sure, that's a beautiful line. Regulation is too important to be left to the regulators. On that note, thank you so much, sir, for making time today. Lovely talking to you as always.